Peter Rose, Longwood Currency Trading. It's the middle of March, actually getting toward the end of March here, 2021. Today I wanted to cover a relatively complex topic in a pretty simple way. It's a definition. What I want to discuss is the difference in the terms taking a risk versus assuming a risk. Now, you know, it may seem like inconsequential to be parsing terms like that, but I would strongly caution you in that I've said many times in my videos and in my 50 years as a martial artist and talking about the power that our thoughts have, and those thoughts are manifest through the words that we use, and the words that we choose to express something creates an emotional reaction in us. You know, if I say sweeping fields of corn, I'm going to get a reaction from that. Well, you know, I was originally from Illinois, and so I know what a sweeping field of corn looks like, and it's a very beautiful thing. Or someone from the city, they may not get that. But the fact that I say it's a sweeping field of corn may give a different impression than if I just say cornfield. So the terms that we use are impactful in how we emotionally perceive or react to something. And so in trading, one of the least understood concepts really is that of risk. It's something that most educators discuss, but they discuss it in a very mechanical sense. And so today, well, I'm going to discuss it more in terms of its emotional impact. And that emotional impact is manifest in us differently is if we are viewing ourselves as taking a risk or we're assuming risk. In the currency markets, there's risk, all right? So what could possibly be the difference between taking and assuming that risk? I want to put up a slide here that gives my simple definition of this. Taking risk versus assuming risk. The immediate and simple difference is that taking a risk is gambling, whereas assuming a risk is still taking that risk, but with caution and preparedness in place to mitigate the risk itself, as well as a plan to extract yourself from the situation if the risk manifests itself beyond your predetermined level of tolerance. Holy crap, what is all that? Well, you could say, I'm making an assumption that taking a risk is gambling. Well, let's break it down into, let's break it away from the trading reference, and let's look at it in terms of what we're all familiar with. If I was jumping out off the curb between two parked cars into the middle of the street to get to the other side of the street with oncoming traffic or traffic going on, that would be taking a risk. I'm just running out between two parked cars. But the risk is there with the cars, but I can assume that risk by mitigating it by walking to the corner, waiting for the light to change, and for the cars to respect the light change and for it to stop. And then I can cross the street. The risk of crossing the street is still there, but I've mitigated that risk by assuming it. You see the difference? I've thought the thing through. I haven't just run through two parked cars. I have assumed that risk. Now, you know, I mean, I could go on ad infinitum on examples. You get it. I've done a blog post on my blog site at longwoodcurrencytrading.com that covers this topic with a little bit more definitional clarity than I can in a video. I'm trying to get the emotional impact of this stuff through to you in the video because that's what the medium is good for. Well, so in looking at trading, let's just say that taking a risk is just, you know, look at the chart and say, oh, that looks pretty good, and you put your bid in, and you know, off you go. You've got your trade with no thought as to what price action is doing, or if you're using indicators, what the indicators might say, or what time of the day it is, or nothing. You just, I'm going to take a trade. And unfortunately, that's how a lot of people are taught how to trade. You know, or go on signals, these signal services. Oh, it just makes me crazy. Well, if taking the risk is just jumping in and doing bid-ask, well, how do you assume market risk then? Well, you got to understand the market. What does that mean? Well, you know, let's not be stupid about this stuff. If you don't know what understanding the market is, yeah, you know, you need to go to babypips.com and figure all that stuff out. But you can assume risk by understanding the market, understanding what price action is, what tools are available to you to mitigate that risk. For example, stop loss orders or ATR analysis or that sort of stuff. And you need to understand the psychological and emotional issues that come with risk. And you have to match your personality up with the methodology of how you trade. Are you a long-term trader or are you a scalper? You know, those are the two big swings in that. So I think that defines that a little bit better. Let me pop up another slide here for you, because this is really critical to understand what I'm talking about. Primary to better understanding risk is to recognize that no matter what you do to mitigate a risk, the risk itself is still there. Mitigating the risk does not reduce the risk. It reduces your level of the risk. For example, in that scenario of me going to the crosswalk and waiting for the light to change, the risk is still there of a car blowing through that light and running me down. You know, I've taken steps to mitigate it. I get in the car when I'm driving. I put my seatbelt on. That doesn't mean that I won't get hit so hard and that I won't get hurt. I was in a car accident in 1980. I got broadsided. I had a seatbelt on. My head snapped against the driver's window and broke the window out. And you know, I've had problems with that crap ever since. But I mitigated that risk. If I wouldn't have had the seatbelt on, I probably would have gone through the windshield, or at least a side window or something. They didn't hit me very hard, but it doesn't take very much of a hard, a fast hit or a hard hit when you get 2,000 or 3,000 pounds ramming into you to cause some damage. You know, I'm sitting with a trade now that's 2.5% against me on my bank. I'm on a higher time frame chart than I normally would, so my standard 8-pip hard stop rules and all that stuff kind of go out. I have to replace that with a different methodology. The reason I'm doing that is because I've staged into the trade, and when you do that, that hard pip stop rule that I have goes away. The 8-pip hard stop rule is a mitigation of the risk, but once you trade on a higher time frame, then those rules tend to change, and when you stage in, the rules tend to change. So I'm in a different set of rules now, and I've mitigated that risk to that next level. If it continues to go against me, it will result in probably a 3 or 4% hit against my bank. But since I've made, I don't know, 4 or 5% in the last 5 days, I'll be still ahead for the month. It's a balancing act. You can't win all the time. You can't avoid the car accident just because you wear a seatbelt or you drive the speed limit or whatever. So for the most part, by assuming the risk, what you're doing is you're taking all the steps possible to mitigate it, which increases the probability that you will succeed in not suffering the full force of the risk. But you're still exposed to the risk. In the example of a car, I could still get in a car accident, but because I got my seatbelt on, you know, I didn't get hurt. In the case of the trade that I'm currently in, should the trade turn around and move in my favor, whereas my profit, and I'm trading with some heat here, though my profit target is 30 pips away, should this thing go into profit 3 or 4 pips, I'm going to be out. And because of the heat that I have, I'll have a nice day. I'll make let's see, $100, $200, but not the 30 pips. But that's okay because my original plan didn't work out. It's late in the day. Well, I mean, it's noontime, and I usually don't trade after noon. And so I have to change the rules. My mitigation changes. If the mitigation that I've used is insufficient to spare me from catastrophe, the next rule is, here's where my stop should be. This is as much pain as I want to suffer, and I'll just get out, and that'll be it for the day. I got to come in and try it again tomorrow. So implementing this type of risk mitigation, this so that you can assume risk, these rules are much more fluid than the actual, like a trade entry rule, because you're dealing with emotion. You can't put a hard rule to an emotion. You have to be able to work within that. For example, I go long with no stop. That's taking a risk, right? If I set a stop, then I've mitigated the risk, but the risk is still there because the stop could get hit. And so I get hit with the risk, but not as much of the risk. Mitigating the risk does not reduce the risk. It reduces my level to that risk. Okay, again, repeating what that second slide said. The implementation of these sorts of emotional, psychological risk mitigation rules do need to be embedded in your trading plan. You have to have consideration in your trading plan for these types of rules, for the assumption of risk. You have the mechanical rules for taking the risk, but you also need the more soft approach to the rules, the psychological rules that deal with risk assumption and the mitigation of that risk. That can be really, really, really complicated. And so if we go off to this third slide here that I've got, you want to be able to identify in that trading plan the areas, not the times, but the areas where you might employ a risk mitigation rule. So just really briefly, to make the trading plan really simple, you have opportunities for risk assumption considerations and rules during the trade entry process, early in an active trading position where you get a price reversal, late in an active position where you get a price reversal, and you might have some mitigation rules and assumption of risk when you are post-profit target price action. What do you do then? Because you don't want to say, oh, okay, I'm going to let this price run way beyond that price target and then have the price come all the way back at you and end up with a loss. So that you need some assumption of rules in order to do that. So another sip of coffee. And I want to just repeat, I'm looking at my screen here. I'm going to repeat that second slide. Primary to better understanding risk is to recognize that no matter what you do to mitigate a risk, the risk is still there. Mitigating the risk does not reduce the risk. It reduces your level of that risk. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.